Our goal for this webinar, and also for the third annual State of the Sector report that is now available on our website, csaf.net, is to share a snapshot of what this market looks like, how it's growing, and also where, from our perspective, it's stuck. We hope that our experience informs how other financial institutions approach the market, as well as how donors, investors, policymakers, value chain actors, full range of stakeholders target the resources to address more of the unmet need. For today's agenda, first I'll provide a bit of background on CSAF, our objectives, our recent activities. Next, Hugo will share high-level trends regarding 2016 lending activity across the 11 institutions. Gael will then discuss some specific trends we're observing across countries and value chains. We'll discuss some of the challenges and opportunities in the market and close by previewing efforts that CSAF is considering for the months ahead. And we plan to leave about 20 minutes at the end for questions. So before digging into the results, I'd like to thank our partners, MasterCard Foundation and Small Foundation, for supporting CSAF. CSAF is not a legally registered entity. We don't have a secretariat or any full-time staff. Senior leaders from each institution dedicate a portion of their time, and then my colleagues and I at Root Capital currently serve in a coordinating capacity. So the support of partners like MasterCard and Small, who recognize the importance of building the industry infrastructure, cannot be overstated. This report also would not have been possible without our data partner, which is Mix. I'm sure many of you are familiar with Mix from microfinance, their work leading data and analytics to promote financial inclusion. Mix has been partnering with CSAF for the past 2 years to bring greater standardization to what is frankly pretty messy and inconsistent data, and trying to standardize terms, definitions across the members so that we can present comparable data that's useful for all of you. Their team works directly with each member under a non-disclosure agreement to report thousands of data points on a loan-by-loan basis. They clean the data, they share it back to us on an aggregated basis that protects the confidentiality of our borrowers' business information. And then this data and the analysis from Mix form the basis of our annual report and our discussion today. So on behalf of all the CSAF members, I'd particularly like to thank Blaine Stevens and Ada Dokle from Mix, who have done the heavy lifting on this work. Okay, so what is CSAF and why does it exist? CSAF is an alliance of 11 peer and competitor institutions financing agricultural SMEs around the world. Global representatives meet twice a year in person and have regular calls over the course of the year to advance our collective agenda. And in addition, our colleagues based in Peru, Kenya, and now Central America also meet on a regular basis to discuss market trends, risk factors, and collaborate on practical things, such as a standard loan monitoring tool that we're now using in situations where more than one CSAF member is lending to the same borrower. Our 3 work streams include, first, market growth, trying to expand access to finance for more of the small 450 million smallholders globally and the agricultural SMEs that aggregate them. And this report and webinar are part of that effort. Secondly, to promote responsible lending practices, we've developed and posted on the CSAF website a set of principles to which all members adhere, and at our CSAF meetings, we're regularly talking about how to apply those principles in practice. Third is social environmental impact. We don't take it as a given that increased lending activity will necessarily contribute to positive social environmental outcomes. So we've developed and posted on the CSAF website a set of principles to formalize social and environmental standards for our lending. We collaborate on training and due diligence tools for our loan officers to implement these standards. And as part of our commitment to continuous improvement in our own institutions and with borrowers and other stakeholders, we see this as an ongoing part of our work. So we are first and foremost practitioners making loans and in some cases providing targeted technical assistance to prospective and current borrowers. we're united in our commitment to applying a market-based approach and offering credit to agricultural SMEs in order to advance social environmental objectives at the farmer, community, and landscape levels. So I also want to point out that there are significant differences across the CSAF members. Some of us are larger institutions involved in microfinance, renewable energy, even retail and corporate banking in a couple of cases. Others are standalone organizations focused exclusively on agricultural SMEs. Some raise capital from a handful of development finance institutions, others from thousands of ethical retail investors. Some are structured as fund managers, others as cooperative societies or nonprofits. One sits within a fully regulated commercial bank. Minimum loan sizes might range from $20,000 for one member to $1 million for another. And some of us also make equity investments in agricultural SMEs. But today's webinar, all the data in the report is focused on our lending. Lastly, our presence varies by geography and crops. We overlap in many regions. The very last page of the report shows our lending volume by country and also the number of CSAF members who are present in each country. So I note these differences because the data is an aggregate composite picture of lending activity last year and necessarily conflates the experiences of individual institutions. And then lastly, before handing off to Hugo, CSAF members are both peer institutions and competitors. We are often jockeying for position in certain markets and with larger borrowers where we overlap. But we also recognize that the potential market is enormous and largely untapped, that the risks in agricultural lending are many, and we're usually better off sharing them than going alone. And most importantly, that our collective efforts will never be sufficient to address the full demand directly. So if we're to achieve our ultimate objective of a thriving, sustainable, and transparent market, we must collaborate on a pre-competitive basis. And not just with each other, but also over time broaden the tent to include others in exchanging learning and developing industry standards and best practices. So with that, I'll hand it off to Hugo to go into some of the 2016 trends.
Thank you, Brian. Hello, everyone. My name is Hugo Coudray, and I'm the senior advisor of Altefin. Altefin is a Belgian cooperative and also a founding member of CSAF. You might say one of the smaller members, at least in portfolio size, of CSAF. As Brian mentioned, I have the honor to present you the figures and trends of CSAF lending. It's a lot of figures, so I hope you can follow the slides on your screen. Let's first have a look at some general figures of the market in 2016. Our collective lending of CSAF reached in 2016 $682 million disbursed. All the financial figures I will mention are in US dollars. That doesn't mean that we only lend in dollars. We might lend in euro or local currency, but for the sake of aggregation, everything was converted to dollars. So all financial figures I mentioned are in US dollars. Now, with that 682 million, we reached or helped 765 businesses across 65 countries. And those 765 businesses earned roughly 7.6 billion in combined annual revenue. These businesses, they sourced from smallholders or provided products and services to an estimated 2.3 million farmers, of which more or less 30% were women. And if we look how much of the combined revenue of the businesses reached the small farmers, we see that about 6 billion of that 7.6 billion reached the farmers through the payments they received from the businesses. Maybe one important point is that though the different businesses might be very different in terms of size and stage, there is less variance in farmer profile. We see that across the line, we work, or those businesses work with smallholders that in average manage 2.6 hectares of land. So we're really working with smallholder producers, and that is something that we all have in common within CSAF. Now on the next slide, we will look at some regional differences of the market. First maybe is to see how the growth of the lending was presented over the last years. So compared to 2013, there was a almost doubling of, or more than doubling of our combined portfolio. Compared to 2015, we had a 9% increase, and so which is also not bad for a more mature market, but as a considerable slowdown if we compare to the growth figures of 2013-2014. Now, important to say also is that, as Brian already mentioned, 9% is an aggregate growth number, and it doesn't tell you the full story or the more detailed story, given the variability by country, by crop, and by lender. So the growth might be very different with respect to the country in which it is situated, or the crop, or the lender. If we take, for example, Central America, there we see that for the second consecutive year we have a decline of the portfolio, while in sub-Saharan Africa we saw a big growth of 44%, and that was a very notable trend in our analysis, and we saw significant growth in countries like Ivory Coast and Ghana, for cocoa of course, but also in Eastern Africa, in countries like Tanzania and Kenya. Also in Southeast Asia, we saw important growth, and there important countries were, of course, India, but also Vietnam and Indonesia. In South America as a whole, which is the largest region for CSAF lending, overall lending declined for the first time and dropping by 10%, and this is due in large part to decreased lending in Peru's coffee and cocoa sectors, as well as another year of decreased lending in the quinoa sector of Bolivia. But apart from that, we saw also some pockets of significant growth elsewhere, like for instance in Argentina in the soy sector, in Colombia with coffee, and in Ecuador with cocoa. Now let's see on the next slide some trends regarding our borrowers. Most importantly, we see that we've added 130 new borrowers last year, and there we saw that 4 countries have the largest net increase in borrowers, namely Argentina, Colombia, Indonesia, and Ivory Coast. And if we net out non-renewals of existing borrowers, the total number of borrowers was 765, which represent a 6% increase compared to 2015. Now, an important point to mention is that CSAF members, they are committed to the principle of additionality, and this means that we want our lending to be additive to what borrowers would otherwise anyway receive from other lenders. And in that context, it is important to mention that there is a really positive trend towards increased additionality. We see that 77% of existing borrowers work with just one CSAF member in 2016, compared to 68% in 2014. So there is an increase of borrowers that just work with just one CSAF member. And so that is the increase in total lending does not appear to be a result of lenders crowding in to the same borrowers, but they reach each one new borrowers where they are lending on their own. Another interesting trend is now that more than half of all borrowers are now private enterprises. In 2016, 56% of all borrowers were private companies, with the rest being farmer-owned cooperatives or associations. And the percentage of private enterprises is steadily increasing each year, and is largely driven by the growth in Africa and Asia, where whereas in Central America and South America, they have a longer history of farm-owned cooperatives. We see that in Africa and Asia, the private enterprise is becoming more important as a partner or borrower for CSAF members. When looking at the share of credit disbursed, just 1 minute, if we're still on the previous slide maybe, if we look at the share of credit disbursed, 64% went to privately owned businesses last year, of about 50% just 2 years before. So we also see in the share of credit disbursed that we more and more are targeting privately owned businesses. And we expect this trend to continue, as the process of forming and growing cooperatives tends to be slower than the scaling up of private enterprise. Now on the next slide, we have more information on loan characteristics. Of course, trade credit remains the most frequently used form of financing. We see that about 76% of capital disbursed from CSAF members was for trade credit, and this is typically seasonal working capital loans of 6 to 9 months. As many borrowers have limited assets to pledge as collateral, these trade loans are usually structured using a borrower's purchase orders with a known buyer. And in the markets where we work, trade credit is essential during the harvest season, given the short window to secure crop and long cash conversion cycles. So trade credit remains most frequently, but on the other side, we see that longer-term asset financing is also steadily growing. And from the 22% of year-end outstanding balance in 2014 to 30% of last year's outstanding balance. So there is a clear growth in longer-term asset financing that we can notice. And these loans are typically longer-term loans from 2 to 7 years. And these long-term loans, they allow businesses to invest in things like equipment, infrastructure, technology, and even in some cases, businesses manage internal credit funds so that they can provide loans to farmers for inputs, but as well as productivity enhancing investments such as crop renovation and irrigation. Now, finally, one of the most noticeable trends last year was a 50% increase in the average size of loans made to new borrowers. This needs some specific explanation probably, and by contrast, average loan size for existing borrowers has been increasing at moderate rates, as we could expect. But we were surprised to see this year that average loan size for new borrowers surpassed average loan size for existing borrowers. This has something to do with the policy of some of the CSAF members. Some of the lenders are shifting towards working with larger businesses with financing needs even in excess of 2 million. And again, from the data available, we do not conclude that this upmarket shift in loan size for some members corresponds to less impact in their lending, given that we don't see significant changes in the farmer profile associated with those businesses. And this is an interesting topic, and we will discuss this further in our CSAF meetings, and this might also be an interesting topic for further research. Maybe I should also mention that about half of CSAF loans were in amounts of 500,000 to 2 million, but still also a quarter of CSAF loans were for amounts less than $250,000. So I think these are the general figures and trends. And with that, well, I'm very happy to turn it over to Gael, who is going to share a bit more on specific trends by country and crops.
Thank you, Hugo. Good day or good afternoon, everyone, and thanks for joining us. So my name is Gaëlle Bonnieux. I am head of agriculture debt investments at Responsibility Investments. So just quickly on Responsibility, we are an asset manager based in Switzerland and specialized in development investments. We invest in 3 sectors, in financial inclusion, renewable energy, and sustainable agriculture, both in debt and in equity. So we've been investing in agriculture since 2005 and are also, as Altafin and Root Capital, a founding member of CSAF. So I will now highlight some commodity-specific trends, starting with coffee. So, as in previous years, coffee accounts for the largest share of CSAF lending by crop, but that share has declined from 55% in 2014 to under 40% in 2016. So the coffee lending varies significantly by region, from 88% of lending in Central America to 18% in Sub-Saharan Africa. But the drivers of the decline in coffee lending over the past 2 years vary, but we can mention here 2 main reasons. The first reason is the prolonged period of lower coffee prices after the price spike into 2014. And the second is the slow but sustained recovery from the coffee leaf rust disease in Latin America. So despite this global decrease, there were some notable growth trends in CSAF lending to the coffee sector, and there are 2 that I would like to highlight today. The first one is Colombia, and the second one is Indonesia. So first, the lending to Colombia's coffee sector has doubled in the past 2 years, as the country's overall coffee production has rebounded from a dip between 2008 and 2012. In Colombia ranks second worldwide in annual production of Arabica coffee, with 95% of producers in the country cultivating less than 5 hectares. So in the wake of the historic peace accord in Colombia, we have seen increasing opportunities to finance producer organizations that were previously in conflict zones and thereby support the process of peace and economic development in the country. And second trend in Indonesia, so while the absolute amount of credit disbursed is low, we have seen a significant rise in coffee lending in Indonesia, and especially on the islands of Sumatra and Sulawesi. And given the environmental pressures on tropical forests from crops like palm oil, for example, shade-grown coffee presents an attractive alternative for farmer livelihoods, and also as an agroforestry crop in buffer zones of high-value conservation areas. So beyond coffee, we saw significant growth in 3 other products, namely cashew nuts, macadamia nuts, and also in cocoa. So in cashew, the growth has been quite substantial, so the lending more than doubled, with most of the growth taking place in Vietnam, followed by Nigeria and Burkina Faso. But also, although cashew is increasing, CSAF lenders remain cautious due to a heightened risk that stems from limited operational and managerial capacity, especially among earlier stage cashew processing businesses. So issues such as inconsistent access to power to operate the processing facilities, and also the periodic labor shortages have presented major challenges to cashew lending, especially in West Africa, which produces over 1/3 of the world's cashews. So in 2016, for example, the portfolio at risk at 30 days in the cashew sector stood at 10%, which is slightly above the industry average. That's around 7.8%. The macadamia nut sector, also in Kenya, continues to expand, with a volume of credit exceeding $10 million, up from just $3 million in 2014. Like for cashew, there has been a strong increase in demand for nuts, especially in Europe and the US. Finally, in the cocoa sector, disbursements grew 20% to almost $80 million, and more than 40% of this credit, or $34 million roughly, went to 22 borrowers in Ivory Coast, which is the world's largest producer and exporter. And it's interesting to note that only $3 million went to cocoa enterprises in Ghana, which is the second largest producer. And this is in large part due to the country's more regulated export market and the presence of the cocoa world. We're seeing other countries turn to cocoa, especially as coffee production becomes unsuitable at lower altitudes. So in total, CSAF lenders work with cocoa businesses in 14 different countries, and lending to Ecuador's cocoa sector, for example, more than doubled in 2016. So Ecuador in cocoa seems to be, according to specialists, the rising star. Finally, I should note that we are focusing on those crops today because they represent the majority of the lending of CSAF members, but we finance businesses across more than 20 different crops or products, including cotton, maize, millet, rice, sesame, sorghum, tea, quinoa, just to name a few. But it's a combination. It's a combination of export crops and also food crops. So I will now hand over to Brian again.
Yeah, thanks, Gael and Hugo. So we did a survey among CSAF members for outlook on 2017 as well, and the growth projections are very similar to the past couple of years. Continued moderate growth in the 5 to 10% range, pretty consistently across the members with a little bit of variation. And the leading countries that members have identified as having growth opportunities are Colombia, Indonesia, Uganda, and Kenya, which also tracks the trends that we've been seeing in the last couple of years. And Gael mentioned some of the specific, the risk levels for specific industries as an overall lending across all the sectors where CSAF works, all the crops. The portfolio at risk 30 days dropped from 11.3% in 2015 to 7.8% in 2016. So we're seeing a positive trend on that dimension, but certainly 7.8% is higher than any of us would wish, and several members are tightening credit standards and being more conservative in this environment. So with that, I wanted to ask Hugo and Gael a couple of questions, and then we'll open it up to questions that we're receiving from the group. So Hugo, beginning with you, we did another survey with members around non-performing loans in 2016 and found that most repayment rate, issues and defaults occurred with businesses where management capacity was limited. So could you share a little bit Ultrafine's experience, both in terms of risk management and also your outlook and some of the growth opportunities that you're seeing over the next 12 to 18 months?
Thanks, Brian. As for Ultrafine, I think mainly in the period 2013-2015, we've seen an increase in the occurrence of defaults, difficulties of repayments from our partners, and of course there might have been external events that have triggered these defaults. But in our analysis, I think it's often the weaknesses of the organization that makes these organizations unable to cope with these challenges. And even independently from these external events, we saw quite a few organizations that got into trouble because of internal factors, such as lack of management capacity, governance issues, problems with membership loyalty, weak balance sheets in the sense that they are over-indebted or undercapitalized, and so on. And well, in our case, we had more problems in Latin America than in Africa and Asia, but that's probably has to do with the fact that a large part of our portfolio is situated in that region. As a consequence of that increased default in that period, 2013-2015, since 2016 we have been taking less risk. This has impacted on our loan portfolio, but we also have been looking for other guarantees or for other funds to financial technical support, and I think with some positive results. So we have been trying to look for ways to de-risk some of our investments or lending, and at the same time we have been looking for assistance or finance to provide technical assistance to strengthen those companies or those organizations, as we think that with more stronger organizations also our risk will diminish. So this is the, let's say, the trends that we have been working on, in the sense that the growth of defaults in previous years we have tried to counter with some measures for mitigating risk on one side, and on the other side to provide technical assistance to those organizations. But we think there's still a lot to do on these risk mitigating methods or tools, and on technical assistance for those companies. So this is certainly you know, a challenge, but at the same an opportunity to strengthen those smallholder businesses for the future.
Thanks, Hugo. And kind of similar question to Gael, but slightly different framing, which is responsibility has been growing your loan portfolio pretty significantly over the last few years. You now are the largest share of CSAF lending. So what are some of the interesting opportunities that you're seeing, and what challenges are you confronting?
Yeah, so it's true. We've been growing over the past 2 years, and it's mostly a result of the increase of the average ticket size, which basically comes from the fact that we changed our investment universe from just production and export only to the entire agricultural value chain segment, because we thought financing other companies in this area would better address the global challenges agriculture faces today. And if you expand across the value chain and you go to more what we call the midstream players, or companies that are involved in processing, those tend to be a bit larger with more assets and a bit longer track records. They still buy from smallholder farmers and have some outgrower schemes, but clearly their requirements and financing needs are slightly larger. And all those companies that have also that are a bit larger also have and have more assets, have needs for long-term financing. So that explains both the increase of the average maturity and average invested amount as well. Still, the challenges remain. Hugo mentioned a few, and we face exactly the same challenges. We have also seen or experienced some exogenous market risks. And just to mention two, we had climate events that affected agricultural businesses and a lot of our clients, and also the decrease of global food prices that also affected a large number of companies. So in terms of climate, we were mostly impacted, or in our clients, by El Niño and La Niña, those two phenomena that usually go together, with El Niño being the warm phase and La Niña the cold phase. And so those events generate fluctuations of temperature, right, between the atmosphere and the surface of the ocean, and the impacts can be very different depending on the region, and can go from massive floods to drought, etc. So very few agricultural businesses are actually equipped to mitigate those risks. Very few are diversified, and they have very limited access to climate insurance, for example. So that was a challenge, and we also had price risk as an issue. So global food prices decreased dramatically between mid-2014 and mid-2015, reaching a 5-year low in July 2015, and in some issues obviously in 2016. So this decrease affected the margins of a number of companies that produce, process, or or trade cash traded products. And according to the last estimates of the FAO, the prices are expected to remain actually flat or decline for most products. So this will remain a challenge. Infrastructure and FX risks are also major challenges, just to mention a few. So we have try to mitigate those risks in our portfolio by selecting companies, as I mentioned before, that are a bit more diversified or are a bit less exposed to the extremes of the value chain. We are looking at providing climate insurances to some of our clients, so I'll manage this at the portfolio level. So despite those challenges, we see opportunities coming over the next 12 to 18 months. So the demand for sustainably grown products continues to increase globally, especially for organic products, and that represents an opportunity for agricultural companies. And we still see a large unmet demand for long-term financing, and will probably further increase the share of this type of investment in our portfolio.
Thanks, Gael. And we're going to turn to Q&A. We've been getting a lot of questions. Thank you to everyone. We'll do our best to answer them. We'll bundle them. We'll follow up with people individually offline. We'll also try to post some answers on the CSAF website. But a number of the questions relate to what's needed to grow this market. And the slide has three broad buckets. We have some more specific ideas that we also will be developing in the coming months. So the first is around appropriate supply of capital. We all spoke about the challenges of lending into this market. There are systemic risks related to agriculture that are mitigated in many more developed economies through disaster relief and insurance products, through loan guarantees, through subsidized, publicly subsidized agricultural lending, first loss capital, etc. Those typically are not available in our markets, and so CSAF members are effectively building Frankenstein balance sheets, trying to cobble together different risk mitigation mechanisms, and it's rather inefficient. It makes it challenging for us to grow our lending, and it's a barrier to expanding the market. We're also seeing more of the development finance institutions, multilaterals, private investors coming into agricultural finance, which we see as a very positive sign, but often with risk return expectations that don't match what we're seeing in the market. And so how do we create more of a dialogue around the impact that we're trying to achieve, the most financially efficient way of doing that, and blending different types of capital. We have some specific ideas in the report, and happy to discuss that further. The second area where we see barriers to growth is around demand, and specifically the addressable demand. So we know that there are 450 million smallholders. Most don't have access to finance. Only a small fraction of those farmers are aggregated into businesses that are finance ready. And how do we promote, support more business formation and really get those businesses to the point where they can apply for and responsibly manage credit? The technical assistance market tends to be project-based, large donor projects that are in specific geographies and value chains, and leave a lot of the market uncovered. The businesses that most need technical assistance tend to be least able to afford it. So we have some ideas around more flexible market-based approach, more of a voucher system where investors can offer support to prospective borrowers, enterprises that might be on the cusp of being ready for investment, and they can go out into the market and access technical assistance with a cost share as well. Certainly attracting more talent into the sector is essential, and what Hugo and Gael were speaking to around management capacity and whether it's at the lower end of the market or larger businesses that are trying to manage price risk volatility, climate change, etc. There's just a need for more talent, and so what are incentive programs to bring that talent to the sector? And then the third bucket is around strengthening the enabling environment through legal and regulatory reform, and that's really going to vary country by country. There are some countries that impose restrictions on foreign capital. Tanzania is a country where foreign lenders are not allowed to lend in local currency, so CSAF members that want to be lending in domestic value chains for staple crops, food security and nutrition are not able to make those loans and repatriate funds. So that's a very specific barrier. But more broadly, we see the need over the next 10 years and more to develop the enabling environment, the type of supportive infrastructure that exists in more developed economies for agriculture. Some of the things mentioned earlier around insurance, risk mitigation, crop research is certainly required as well. So maybe there's a question that we've received that I'm going to pose to Gael, which is around the impetus for some of the movement to larger loans. It's not just been responsibility. A couple other members have gone in that direction. But Gael, is that, how would you define that in terms of organizational strategy? Is it response investor expectations around returns that are motivating that? Is it a less competitive part of the market? How do you think about that strategy? Mm-hmm.
So it's a mix of things. So as I mentioned before, initially it came more from the interests or the needs that we received from the market. So the signals we received from the market, where we saw that there was a demand for those types of loans. So the beginning, CSAF was focusing on lower amounts, but you also have the mid-sized growing SMEs that also need access to finance, and around $2 million, there were actually very few players willing to lend to them. So when we saw that there was a demand and that was across the value chain, we said, okay, let's structure the team and our operations in order to tackle that demand. It didn't come from investors necessarily. Although, of course, investors are looking for both performance and impact. And if you want to achieve performance, you need to operate at the lowest possible cost, let's say. And we mentioned before that financing agricultural companies below $500,000 or even below 1 million is extremely costly. So it's actually difficult to reach that segment and deliver the expected performance at the same time. So having a mix of, let's say, 80% of the portfolio that's in that range and 20% that's slightly larger allows us to maintain a cost base that's more acceptable for the investors, basically. I hope that answers the question.
Thanks, Gael. So I wanted to ask you a question, which is kind of a composite of a few questions we've been receiving around the impact of climate change in our lending, and also around financial product innovation. Ultrafin has been working in Ivory Coast with a cocoa cooperative that's featured in the report. In addition to your trade credit lending, you've been working with them to offer a long-term loan for farm renovation. So if you could talk a little bit about the need that you've seen in West African cocoa and how that loan is intended to mitigate climate change and invest in the future.
That's also a question for me? Sorry.
Responsibility has also been involved, so feel free to jump in, Gail.
Okay. No, so in terms of the long-term financing part is, I also saw that there was a question on the additionality for larger amounts. So typically for this type of projects, the amounts are actually relatively high, and it's a different type of project that requires very long-term financing, and the availability of financing for this type of project is extremely limited or non-existent today. So when we work with clients for a few years and we've been providing short-term financing and they have needs for long-term financing, we obviously want to support them, especially when it's around this type of projects. So typically in Ivory Coast and in Ghana, actually in West Africa, cocoa production has been decreasing due to a number of climate events. So if you finance the planting of cocoa through agroforestry systems, that basically helps to bring resilience to farmers, also to increase their revenues because they diversify the crops, and to basically have, well, the systems as well overall that are more resilient and to contribute to basically mitigate climate change.
Thanks, Gail. Hugo, do you want to jump in also on that question, or feel free to pick out any from the list?
No, maybe what I can add with respect to that specific partner in Ivory Coast, EcoKim, is that, as Gail already mentioned, there is really a need for longer-term finance to counter these climate effects, also the degradation of the present cocoa plantations who are not any longer productive. And so renewal of plantations is very important, and this needs long-term finance. Now there is another need for long-term finance in the sense that big cooperatives or second-level cooperatives like EcoKim, more they want to integrate, have an integrated value chain, and they want to also become more involved in processing, at least in exporting and then in processing. And this requires investments. And these investments need long-term finance and even need equity. So you mentioned it before. Altafin has also launched an equity fund for these kind of organizations, and I think this is the next step also, and another opportunity, that is to provide equity for some of those bigger organizations that want to be a bigger player in the whole value chain. So that is something that I wanted to add with respect to this particular partner in cocoa production in Ivory Coast.
Thanks, Hugo. Couple of other points. There's been a question around big data and how to bring it to our sector, and certainly there's a lot of innovation that's happening now in the financial inclusion sector, using mobile technology, using social media. We've yet to really see much of that innovation extend to the small and medium enterprise level, and there are challenges, simply the lack of data that's reliable, and also the lack of volume around that data, as opposed to thousands or hundreds of thousands of individuals whose data can be aggregated. So we expect that challenge to be cracked in the next few years, but we're not seeing yet how to apply big data in our portfolios. There's another question around crowdfunding and smaller loans in the below 100,000 range, and Kiva, the crowdfunding platform, has been expanding their lending. They're facilitating loans directly to social enterprises, and Root Capital has collaborated with Kiva to steer $25,000 to $50,000 loans to some of those businesses, and we think there's more opportunity there. And then there's a question around local value chains, and we didn't speak to it specifically, but foreign exchange risk is a challenge for many of the lenders. And then there are also, these are much less organized value chains. The offtake agreements with buyers are less established, and there tends to be less transparency, traceability in the supply chain. So certainly we all have ambitions to expand, and they're doing so at different rates in local value chains, but coming up against those challenges. Maybe just send it back to Gael and then to Hugo for one last parting comment, if you'd like.
No, I think that's it from my side.
Same for me, Brian.
I put you both on the spot. Well, we're basically at time. Thanks to everyone for participating. I think we had well over 100 people in the call, lots of great questions. We didn't get to all of them, so we'll try to do that offline. We encourage you to download the report at csaf.net, and again, please do send us feedback. Thank you.